Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak, with over 15 years of commercial broking experience focused on the middle market, upper middle market, and national account space. The Wolf of Property and Casualty is a practitioner-led P&C education designed for brokers, buyers, and carriers. No bullshit, each and every episode, nothing to sell here. Talking about the way that I used to do it for many, many years. I was blown away by the feedback I received from some of the business income episodes that I've done. And frankly, I'm not surprised because this is one of the more challenging and technical aspects of commercial insurance. I said it before and I will say it again. This is an area where if you become very proficient at, you can excel. You can be better than your competition if you're a broker. And frankly, buyers out there, I think it's the area of insurance where you're constantly asking for help. And I think the broker community has underperformed. And carriers, I hate to call you guys out, but when I was an acting professional, it was very rare that I could ever get real help from underwriters as to business income evaluation. And again, it comes down to this idea that it's one of the few areas in insurance that doesn't have a definitive answer. If this, then that. It's not, how do I pick a number? And I think it's something where you have to be comfortable sitting down at a meeting where you don't know the outcome. So much time as a broker, I was planning for my meeting down to 10-minute, 15-minute intervals. What I'm going to say on this page. It's about control. I want to control the narrative of the meeting. Doing a proper job to calculate business income requires everybody to know that there is no perfect science to this, and requires a fair amount of on your feet thinking. And it requires the ability to understand and think about how a business operates. And it requires some time to understand how company financials work. So I used to have this book. I wish I could find it. I think I gave it to a younger guy I was talking to when I was an acting professional. But there's it's something like how to read financial statements for dummies. And I think they make it in every type, like construction, manufacturing, etc. You have to have a good understanding of how a financial income statement and balance sheet works, because my best relationships with my best customers, we sat down with the most recent financials or interim financials, and we sat down with those. We scheduled at least an hour and we talked through business income. That requires you to have a fundamental understanding of how business income works, but it also requires you to understand how their business works. These meetings are ones that make your customers stay. These are meetings that make them believe that you inherently understand their operation. So as a result, some of the episodes I've done, I got some follow-up questions from some folks that I've really enjoyed answering lately. I've come up with 4 things that I think crucial to business income that should be thought. And these are each individual. They're not random and they're not ranked, but I'm going to go through them one by one. So extra expense is where I'd like to begin. Extra expense is typically going to be included in your business income. Your form is business income and extra expense. So it is wrapped into the business income number that you put together. Now, extra expense is not the same as business income. Business income is going to be net income plus expenses that would incur it if you for the otherwise loss payable, and then plus or minus payroll, and then extra expenses. Extra expenses typically need to be expenses you incur to otherwise reduce the loss. As a result of this, extra expenses aren't going to have a deductible, whereas business income is usually going to have a waiting period, 24 to 48 to 72 to 120 hours, a waiting period, not a dollar amount, meaning from the moment that you have a qualified loss, you have to wait a certain number of continuous hours before business income starts paying. Extra expenses, because it would be counterintuitive, start right away. If I want you and I want to encourage you as your insurance carrier to spend money to stop the bleeding, I'm not going to make you wait 24 hours. These are the things I always talked about, because I call it a slush fund. It's the one area where you should always buffer the number a little bit up because there's things that come up. One example that I used to use of the things you never thought about is if you have a fire at your building, the fire marshal is going to take like a month and a half before he even probably tells you if your building is okay to be demolished. That entire time, you got to put a century fence around it. That might cost you 25 grand a month. It's going to be a slush fund for those expenses that either reduce the impact of the loss or are otherwise containing the loss. The biggest one I always talk about is temporary space. Depending on what kind of operation you are, you're going to need some temporary space. You're going to need a home base. Unless you're, a technology company where everyone works from home, most businesses need space. So you're going to need to rent separate space. and you're going to have to rent it when you're at a disadvantage with leverage. Even though commercial real estate is really soft right now, depending on what kind you're looking for, when you need it yesterday, you're going to pay going market rate. Expediting equipment. If you're planning to rebuild, or if you had a smaller fire and you need to get new equipment, expediting anything. You go to the post office. If you want to send it overnight, it costs more than if you want it 5 days from now. Well, getting your hands on anything, new product, secondary product, getting your hands on anything faster costs more. And your insurance company is willing to pay you for that if it's going to reduce the impact on your overall business. Again, extra expense dollars are meant to be spent because they're going to be far cheaper and they last a lot shorter of a time period than true net income. So the insurance carrier wants to motivate the insureds to use these dollars. Temporary labor or overtime. This is different than payroll. If you have to bring in additional workforce or you have to pay overtime, technically comes out of your extra expense bucket. Let's say you use a third party. I talk to my customers a lot about this. Do you have anybody that you would trust to make your product, even though your margin would go to zero? So a lot of my manufacturers, it wasn't rocket science or a trade secret what they manufactured. They had the tooling equipment, for example, but people had the equipment. So if you're, pressing John Deere seats, someone else has vertical presses. They just need that tool or die equipment, and maybe they already have it. So can you pay a third party to get you the product to satisfy your obligation to the customer? Those costs, those extra expenses that you incur to keep those relationships intact need to go into there. And that becomes really hard to sit down with the customer and say, which product? I mean, these are the kinds of conversations I'm telling brokers. You got to be okay having that. Like, hey, what are your 5 biggest customers? Do you have anybody else that could make the parts for them? Who'd you lose to or who'd you win against when you bid this project out? All of these extra expenses, whether marketing expenses, whether your salespeople have to go out and schmooze with your customers so that they don't leave you while you're in the midst of a partial fire. All of these expenses. This is one of those where you come up with as many as you can. And then I would always tell customers, this isn't where we gross it down. This is where we gross it up maybe by 20%. Those expenses, again, are not going to have a deductible. The other thing I wanted to note, you can have an extra expense only policy, meaning there is no business income. Types of organizations that have no leniency for any downtime. Think about a hospital, for example. They might buy EE only type policies. They don't have the ability to be down no matter what. So they're not really worried about funding business income. They're worried about just extra expense policies. The benefit of an extra expense policy versus a BIEE combined form is that sometimes those extra expense policies are going to give you the ability to have no coinsurance. They're going to give you the ability to have no period of indemnity, meaning you can run it as long as you need it. They're not going to have to necessarily satisfy the conviction of reducing business income. The slush fund becomes more usable. That broadens, in theory, the scope in which you can spend the money. It also might make sense to have an extra expense only policy. And I used to work in startups a lot. If your company is operating at a net loss, meaning if you're in an early stage startup environment and you might need extra expenses because every company does, but you're projecting a net loss of $10 million this year, it's going to be hard for you to justify where that business income comes from. And so it's cleaner and easier sometimes to take that business income and some of the things that come along with it on an ISO form, like coinsurance, like deductibles. Sometimes it's just easier if you know you're going to be operating a loss to have an EE only form. Number 2, continuing expenses. So business income, I've often said, look at profit and start there. But what are these continuing expenses? I'm going to point out 3 or 4 things that I think get forgotten about. Because if you're doing continuing expenses right, what I used to do is I used to take the expenses that are pulled right out of the accounting system of the customer, and we used to go line by line. And there are some things in there that you don't want to get hung up on, and things for buyers that are a little bit squishy. First one, payroll is the biggest decision you have to make. There's a couple ways you can handle payroll. I always encourage my customers to include payroll because it is hard to rehire your job force. If your facility burns down and you don't have payroll included, traditional and ordinary payroll included in your business income calculation, you're essentially saying you're either going to pay your workers out of pocket who can't work or maybe can help with cleanup with shovels, but you're going to pay them out of your pocket, even though you're not producing any revenue. That's a tough pill to swallow when you could have insured it. Payroll's got 2 sections. Ordinary payroll is your production staff. Executive payroll, manager payroll, leadership payroll, that's automatically covered in your business income. Whether or not you account for it, it's going to come out of there and you can deploy it. But ordinary payroll, the bulk of your production payroll isn't necessarily covered unless you elect it. So you can exclude it altogether. I never recommend it because if in 6 months you think your business has a shot at being back up and running, do you think you really want to hire you want to go back out into a workforce where they found new jobs and you think they're going to come crawling back? Probably not. So I used to encourage my customers to always include some form of payroll. You can do 30, 60, 90 days of payroll, which is an actual endorsement to your policy that just says, of my total business income number, the way I calculated it, which means I don't have a year's worth of ordinary payroll. I've only included 90 days of payroll. It gets you away from any potential coinsurance provisions that might take place. So that is an option. But I always encourage my customers to include ordinary payroll on an annual basis because I think that there's goodwill that comes with that. And I think it's impossible to rehire an entire workforce in most industries. I used to tell a story. There was a sausage manufacturer here in the state of Wisconsin, and they got all this amazing press. They had a large fire, and on the news locally, they would keep showing the workers cleaning streams and picking up garbage on the side of the road. And everyone said, this manufacturer is so generous. Look at them paying their employees to volunteer in the midst of this tragedy. And I used to giggle because they're getting all this amazing press while their insurance company is footing the bill. It's not their benevolence that allowed them to volunteer and hug puppies and shit like that. It's the insurance company through a properly put together business income form. Other things that you can overlook or you might scratch your head: health insurance, continuing expense; debt, continuing expense. You got corporate debt, you got a line of credit, you got to pay interest; property taxes, covered; rent. It was very common for privately held businesses where the owner of the business has a separate entity set up to own the building, and then leases it back to the operating company. Well, if the building burns down, that owner still would like to receive those rent checks because that's income to them in a super efficient way. So if that owner is smart, here's something you can bring up that helps on the business side, brokers. You want that lease between the building owner, and the operating entity. You want that to say, even if there's a fire, you still owe rent payments for 12 months. You don't want a tragedy to the building to stop the payments because the owner would still like to get paid. And then the operating entity can get reimbursed to cover the abatement clause within the lease. And so that's a big number for a lot of large organizations. Here's the tricky one. This is where you get into the accounting side. Depreciation is a non-cash expense. You buy something for $100,000, you can't negate $100,000. You depreciate it maybe over a 10-year lifespan. That depreciation is going to look like a big number, especially on manufacturing operations, but it's not necessarily cash. You have to be very careful with depreciation. It might be a top 5 expense for your customer, and you're going to look at this 7-digit number and say, do I include this in my BI? Do I not include this in my BI? That's an area where you have to really look at how it works. Typically, I would say, because it's a non-cash expense, you want to take it out. You don't want that to be included as a continuing expense unless there is an unusual or specific circumstance or a modification of the policy. But don't get to depreciation and start talking about this non-cash type asset and not know what to do, brokers, because it's going to be a big number for a lot of companies that utilize hard assets. The other piece that I want to talk about is a monthly limitation. This is an old school way of avoiding coinsurance when you want to reduce how much insurance limit you're buying. I don't like monthly limitations. If you do like a 1/4, 1/3, 1/6 monthly limitation, think about a loss. Your money's not equal the further you get away. You're going to need more money in the first month than you do in the second month, than you do in the third month. In theory, your greatest need is in those first 30, 60, 90 days. A monthly limitation says if you got $1.2 million on a 1/3 monthly limitation, you can only take $400,000 per period. I don't like that. You want to be able to have access to the funds that you're paying for. Coinsurance. There's 3 ways to deal with coinsurance. Coinsurance in a business income environment is going to be applied. Less coinsurance might help you. I had a lot of customers that said, or if I need 12 months of limit, I'm not going to have a business to come back to. So you're always going to, and what I always did is I always met with my customers and I always would be figuring out our business income limit for 12 months to start. And then if they wanted to, we would reduce it through the use of coinsurance. Meaning, if they believe that they could be back up and running in some way, shape, or form in 9 months, we would apply coinsurance, 75% coinsurance. Or, if they wanted 6 months, 50% coinsurance. But the coinsurance should be the percentage of the total 12-month limit that you otherwise would need for an annual limit And 50% would mean you're hedging your bet that you can be back up and running in 6 months. A monthly limitation, albeit I don't recommend it, would eliminate coinsurance. The way you really want to do this is you want to talk to your underwriter. Even if you're falling short of a 12-month number, you really want agreed value. Agreed value saves you from any risk of having any coinsurance provisions. Business income is even worse than property values. It is hard to know once a year what you actually might need at the time of loss. Having coinsurance on business income is risky, no matter how cute you want to be with developing your limit. The last piece, and this gets overlooked because it's a, oh yeah, and but, extended period of indemnity, extended BI, we used to call it. Your period of restoration starts from the moment you have a loss until you're operating at the same capacity you were pre-loss. Extended BI lets you to continue to draw on your business income to plug income gaps that you have, even though you're back up and running. Put it this way. You have a fire. Your third largest customer walks away because you can't meet their needs while you're rebuilding. As soon as you're rebuilt, your customer might not just run back to you. They found an alternative supplier in that time period. So that income gap, while you try to earn back their business, that net income, you can collect it even when you're operational. But you have to have limit left. You can't have no limit left. If you used all your limit because you went too narrow on your business income, extra expense, and continuing expenses, and now you're 2 years down the line and you're still trying to plug an income gap because your third largest customer is gone, but there's no limit there, then you're shit out of luck. You're not taking advantage of this. At a minimum, you should have 365 days of extended BI from the end of the period of restoration. So date of loss is January 1st. You rebuild the following January. Then you should have one more year to plug those income gaps. There are carriers out there that are generous. They will give you unlimited extended BI, meaning until that limit's gone, as long as you can demonstrate that you have an income loss, you can go ahead and collect. But again, the trick is you got to have limit. Most people underinsure their business income at the time of a total loss. So this limit, this coverage grant's not really helpful if you get to 3 years down the line and you blew through your limit in 9 months. So you got to budget for this a little bit like your extra expense. You got to have a cushion to add. These are 4 random business income extra expense topics that I wanted to touch base on as a result of questions I've received. Hopefully these help you, but this again is a complex area, but it's one when done right, everybody can feel like they have a more intimate relationship with their insurance program. For the buyers out there and brokers, you become more of an invaluable resource to your customer.